Here is one of the strangest truths in all of finance. You can be completely right about the future and still lose everything. In the year 2000, millions of people bet on a technology that would go on to change the world more profoundly than almost anything in human history. They were right about the internet, right about all of it, and most of them were financially destroyed anyway. Because being right about the future and being right about the price are two entirely different things, and forgetting that difference has bankrupted more brilliant people than you could ever count. This is the story of the dot-com bubble, the moment a real revolution collided with old-fashioned human greed and produced one of the greatest booms and one of the sharpest crashes the markets have ever seen. And to understand the crash of 2000, we have to start in the decade that built it. The 1990s were, for America, a decade of almost unstoppable optimism. After the stagnant, painful markets of the 1970s, the stock market had roared back to life. Through the 90s, the great Dow Jones Index didn't just rise, it multiplied, climbing to heights that would have seemed like fantasy a generation earlier. The Cold War was won. The government was running budget surpluses. There was a feeling that the good times might simply never end. And then, into that mood of boundless confidence arrived something genuinely revolutionary: the internet. Now, this is the crucial point, the thing that separates this bubble from the tulips and the wild schemes of the past. The internet was real. It was not a delusion. It truly would reshape commerce, communication, and daily life beyond recognition. The people who sensed its power were not fools. They were right. The problem was never the technology. The problem was what people were willing to pay for it. Wall Street looked at the internet and saw a new frontier, a gold rush, and a new generation of tech titans became the faces of the future. Bill Gates, Steve Jobs, Larry Ellison, and a young bookseller named Jeff Bezos, who had just started selling books out of a website called Amazon. The rule became simple and intoxicating. If a company had .com at the end of its name, its stock went up. It didn't seem to matter what the company actually did. It didn't matter whether it made a single dollar of profit. All that mattered was the story, the promise that this was the future, and you had to own a piece of it before everyone else did. Investors stopped asking the oldest, most important question in business: how does this company actually make money? In its place came a new question: how fast is it growing, and how many eyeballs is it capturing? Profit was old economy, growth was new economy, and in the new economy, the old rules, people said, no longer applied. Those 5 words, "this time is different," are the 4 most expensive words in the history of finance. And an entire nation was about to say them in unison. All of this excitement concentrated in one place: the NASDAQ, the stock index where the technology companies lived. If you traded stocks today, you'd know it instantly. In the mid-1990s, the NASDAQ sat around 1,000 points. Then it caught fire. It didn't climb. It launched, roughly 5-folding in a handful of years, until on the 10th of March, in the year 2000, it touched its peak, just above 5,000 points. Money poured in from everywhere, and it wasn't just Wall Street professionals. Ordinary people, teachers, dentists, truck drivers, quit their jobs to trade tech stocks from their spare bedrooms, day trading the mania, certain they'd found a machine that only printed money. You have heard this sound before. When the shoeshine boy gives stock tips in 1929, when everyone is flipping houses in 2005, when your neighbor who knows nothing about markets is suddenly getting rich. That sound is the sound of the top. To feel how insane it truly became, you have to understand the IPO. An IPO, an initial public offering, is the moment a private company first sells its shares to the public on the stock market. Normally, it's a milestone a company reaches after years of building a real business. In the dot-com years, it became a lottery ticket. Companies with no profits, sometimes barely any revenue, would go public, and their stock would double or triple on the very first day, as frenzied buyers piled in. Founders became paper billionaires overnight on businesses that had never earned a cent. And the businesses themselves were often absurd. Pets.com, a website to deliver pet food, spent a fortune on a Super Bowl commercial and a sock puppet mascot, then went from a celebrated IPO to complete liquidation in about 9 months. Webvan tried to deliver groceries and burned through hundreds of millions before vanishing. Company after company, torching investors' money at breathtaking speed, with no path to ever turning a profit. There was even a strange new way to get rich working at these companies. Employees were often paid modest salaries, but showered in stock options. A stock option is simply the right to buy your company's shares at a fixed low price later on. If the stock soared, that right could be worth a fortune, so secretaries and engineers on ordinary wages watched their options balloon into millions on paper as long as the stock kept climbing. As long as it kept climbing. Not everyone was blind. As early as December 1996, years before the peak, the chairman of the Federal Reserve himself, Alan Greenspan, looked at the soaring market and warned of what he famously called irrational exuberance. He was essentially saying, this is detached from reality. The market heard him and kept right on climbing. Warnings are useless when everyone is getting rich. But a few people didn't just warn, they protected themselves. The sharpest example was an entrepreneur named Mark Cuban. He had sold his internet company to Yahoo in 1999 for billions. But crucially, he was paid in Yahoo stock. A lesser man would have held it and ridden it all the way down. Instead, Cuban did something clever. He used a financial hedge to lock in the value of his shares, protecting his fortune against a crash. When the collapse came and Yahoo cratered, Cuban kept his billions. Almost no one else did. The difference between him and the crowd wasn't that he doubted the internet. He believed in it. He simply understood that a wonderful future and an overpriced stock are two separate things, and he refused to bet his fortune on the second. While the boom raged, something quiet and enormous happened in the background, something that would matter far beyond the year 2000. Cast your mind back to the 1930s. After the Great Depression, America had built a wall, a law called the Glass-Steagall Act, signed by President Franklin Roosevelt. Its purpose was simple and wise, to separate the safe, boring business of ordinary banking, holding your savings, from the wild casino of Wall Street speculation. It even split the mighty House of Morgan into two separate companies, which is exactly why, to this day, we have both J.P. Morgan and Morgan Stanley. One wall, two banks. That wall had protected the financial system for over 60 years, and in 1999, right in the fever of the dot-com boom, it was torn down. The law was repealed, the barrier between your savings and the casino was removed. In that same climate, Wall Street firms like Goldman Sachs went public and grew into titans of extraordinary power. At the time, almost no one noticed. It felt like a technical footnote in a decade obsessed with internet stocks. But remember this moment, because the destruction of that wall is what would let the next catastrophe, the one in 2008, happen. The dot-com era didn't just create a bubble. It quietly dismantled the defenses built after the last one. March 2000, the NASDAQ stood just above 5,000, paper fortunes everywhere, absolute certainty that it would go higher, and then it stopped going up. That's all it takes. In a market built entirely on the belief that prices only rise, the moment they stop rising, the entire logic collapses. Buyers vanished. Then came the selling. And once it started, it fed on itself, exactly as it had in 1929, exactly as it would in 2008. The fall was staggering. From its peak, the NASDAQ lost roughly 78% of its value. Not a dip, not a correction. Nearly 4 out of every $5 gone. Trillions in wealth evaporated. And the individual stocks tell the story better than any index. Yahoo, one of the giants of the age, fell from over $100 a share to single digits, a collapse of more than 90%. Amazon lost around 90% of its value. Companies like Pets.com went not down, but to zero, and a man named Michael Saylor, whose company MicroStrategy is famous today for its enormous Bitcoin bets, lost about $6 billion of his personal wealth in a single day when his stock imploded. People today think of crypto as the most volatile thing they've ever seen, but open a history book and you'll find that every market in the grip of a mania is capable of this. There is nothing new about it at all. When the smoke cleared, the vast majority of the dot-coms were simply gone. The hype machines, the sock puppets, the companies that had never made a dollar, swept away, exactly as the reckless were swept away in 1929. A brutal natural selection. But here is the part that matters most. A few companies did not die, they were battered. Amazon had fallen around 90% and looked for a while like it might not survive, but they had something the others didn't, a real business underneath the hype. Amazon turned its first quarterly profit in late 2001, kept reinvesting, and rose from the ashes to become one of the most valuable companies on earth. That is the deepest lesson of the dot-com crash. The believers were right. The internet did change everything. But being right about the technology was worthless if you overpaid, or if you couldn't survive the crash long enough to see the future arrive. If you had bought Amazon near the bottom after it had lost 90%, you'd have made one of the great fortunes of the century. And if you'd bought it at the top, you'd have waited a decade just to break even. Same company, same future, completely opposite outcomes, decided entirely by price and timing. Now, how did the authorities respond to the crash? And this is where the story reaches forward in time. To cushion the blow of the collapsing market, the Federal Reserve, still under Alan Greenspan, began slashing interest rates, cutting them again and again until, by 2003, they reached 1%. Money became almost free to borrow. But that ocean of cheap money didn't vanish. It had to go somewhere, and it flowed into houses. The same low rates meant to soften the dot-com crash lit the fuse under the housing market, the bubble that would explode in 2008. Sit with that for a moment. The response to one crisis planted the seed of the next. The dot-com bust led to cheap money. Cheap money led to the housing mania, and the wall that might have contained it had just been torn down in 1999. 3 disasters, quietly linked in a chain, each one growing out of the wreckage of the last. Strip away the internet, and the dot-com bubble is almost identical to a mania from 400 years earlier. The Dutch tulip craze, when people paid the price of a house for a single flower bulb. In both cases, people bought not because the thing was worth the price, but purely because they were certain someone else would pay more tomorrow. Pure speculation, with no solid ground beneath it. And there's that harsh recovery lesson again, the one that history keeps teaching and investors keep ignoring. After the crash, the NASDAQ did not recover in a year or 5. It did not reclaim its March 2000 peak until 2015. About 15 years later, an investor who bought at the top and simply held for the long term waited a decade and a half just to get back to even. Which brings us, unavoidably, to today. Many people now look at the frenzy around artificial intelligence and ask whether we're living through another dot-com bubble. It's a fair question, and honest people disagree. There's one real difference worth noting. Many of the dot-coms never earned a cent, while the largest companies driving today's AI boom are, in fact, enormously profitable. But there's also one eternal similarity. Every generation, standing inside its own bubble, is completely certain that this time is different. It never entirely is. Whether today is a bubble, only history will tell. Bubbles like these will keep happening in every new technological era, and they cannot be predicted. All any of us can do is understand the pattern and position ourselves wisely. So what does the dot-com bubble leave us with? A handful of lessons paid for in trillions. First, a revolutionary technology and a safe investment are not the same thing. You can be completely right about the future and still be ruined by the price you paid to bet on it. Second, profit is the oxygen of a business. A company can dazzle for a few years on a story and a stock price, but a company that never earns a profit will sooner or later die. No business survives forever on hope alone. Third, and hardest, know when to sell. The entire game was survivable for anyone willing to take a reasonable profit and walk away. It was fatal for those who held on, greedy for more, certain it would keep climbing. And there is a piece of old market wisdom worth carrying with you forever. No one has ever regretted taking a small profit, but a great many people have regretted holding on for a fortune and riding it all the way down into a catastrophic loss. The internet changed the world, exactly as the dreamers promised, but the market had to burn to the ground first, and only the companies with something real underneath survived to build the future. History doesn't repeat because people are stupid. It repeats because the story is always so beautiful that we forget every single time to ask what it costs.